Hello, everyone. I'm Jason Meyers, Inventor, lead architect for Auditchain Labs. Just a quick intro about myself, which I usually do. I was an investment banker for 25 years. I took a lot of companies that some of you know public, and I had a fight with a regulator over an accounting, and that's how I got into crypto almost 10 years ago. And the first thing I saw was accounting, audit, and financial reporting for this thing that they called Ethereum at the time, which I thought they had no idea what they just created, because that's the best use case for this thing. So I began writing the first paper for it, and I called a few folks at Rutgers University, and I thought they were going to tell me that I was crazy, but they didn't. And they invited us to present at the 40th World Continuous Audit and Reporting Symposium, which is the Glastonbury of all accounting and audit technology conferences attended by academia, regulation, and software vendors. So we started the project in 2017, finally, kicked it off, made a lot of mistakes, also had a lot of successes in the development. It was really complex. The financial reporting part of it alone was most difficult. The blockchain part was actually quite easy. So in any event, we went through several iterations of our team, and the team we have now is who got us to where we are today. Where we are today is on the Polygon Mumbai testnet, and our stack is completed, and we are what we believe to be the world's first Web3 enabled, blockchain-based financial disclosure and external audit protocol, if that means anything to anyone. I'll talk about financial reporting and accounting and audit, which is probably three of the most boring topics that anybody can talk about. But nonetheless, to put it in perspective, it is the bedrock underneath the capital markets. Without accounting, audit, and financial reporting, there would be no capital markets. There would be no integrity under the information under those capital markets. It's the bedrock for all regulation in the securities markets. So last year we were named a top 50 company in Crypto Valley, where we're based, in Zug, right by the lake. And that was a real an accolade for us. The problems that we fix, that we are attempting to address, really is, to put it very simply, is to raise the integrity and reliability of financial disclosure information, which, as I said, is the information that underlies the totality of the capital markets. The problems, the additional problems that we're fixing is the state. Are there any Big Four auditors? Anybody from the Big Four in here? Raise your hand. Nobody from the Big Four? FCA, financial, FRC, PCAOB? All right, because I want to be able to talk freely, right? I'm from New York. Yeah, you're from the FRC? You worked for the Financial Reporting Council? So you weren't an employee? Consultant. All right, where's Chris? Watch him. The condition of all financial disclosure information in the world is horrible. Horrible, and we've proven it. In fact, as a small part of that proof, back in November, we did a small pilot with our community, about 150 people. And what they did was they took the third quarter financial statements filed with the Securities and Exchange Commission, and they submitted it to our platform. And our platform is decentralized, so anybody can run what we call a Pacioli node, which is a logic and a reasoning engine that reads, understands, and outputs an analysis of the financial and operating condition of a reporting entity. And what we found was, which we expected, is that almost half of the companies that filed in the third quarter violated basic fundamental accounting rules. Those financial statements are not reliable. Now it gets a little scarier. So you all heard of Bloomberg and FactSet and S&P IQ and those guys? Well, they aggregate data, and the data that they get comes from regulators when it comes to financial statement data. So the data is not reliable. Investment managers rely upon S&P IQ, FactSet, Bloomberg, Reuters to create an investment thesis, which becomes the basis for a capital allocation model for those of you who delegate your money to a money manager or a fund manager. This is the information, in part, that they rely upon. And it's flawed. Why is it flawed? Well, because the specifications that are set by regulators, which are technical as well as political, are flawed. We've proven that. See, accounting, financial reporting, and audit is all based on logical systems, right? A financial report is a logical system. Because in our world, a financial report is a series of multidimensional knowledge graphs and subgraphs that are hierarchical in nature. At the top, you have, in the UK's case, UK GAAP. Underneath that, you have a reporting model based upon a reporting style, which is based upon what kind of company you are: aerospace, telecommunications, technology. They each have a different reporting style. And within those styles, you have your basic model, chart of accounts, standard definitions for financial reporting, things like total revenue, total expenses, net profit. On a balance sheet, it's total assets, total liabilities, equity, or owner's capital, owner's equity, partner's capital, right? On a cash flow statement, it's cash used at the beginning of the period, cash used during the period, cash balance at the end of the period, right? Cash used in operating activities, cash used in financing activities, cash provided by operate. These are all standard definitions in a standard global taxonomy that is set by governments and regulators for each of the jurisdictions that they preside over. And right now, it's horrible. It would shock you to know that there is no integrity and reliability in those financial statements. Everything is based upon the assumption of trust. In the crypto space, which is largely, we use blockchain and cryptography to preserve logic and to preserve data and to create an audit trail. But in the crypto space, as most of you have heard since last June, there's been many, many failures, right? Between FTX, Celsius, BlockFi, none of them even know anything about financial reporting and audit. In fact, they're fighting the U.S. regulators over whether or not they should be classified as an exchange. Every traditional securities exchange around the world is obligated to provide financial and operational disclosure to its regulator and to those that trade with it. This is part of life, right? Setting aside the condition of the data, this is part of life, right? The only exchange on the planet that does that is Coinbase, because they are, in fact, a public company obligated to file periodic financial and operational disclosure in the United States, right? So these are the problems that we address. How we do it is through distributed blockchain-based infrastructure, right? So we have two main components. The first is what we call our Luca suite. Does the name Luca Pacioli ring a bell to anybody? Lived in the time of Leonardo da Vinci. He was the original guy that documented double entry accounting, right? Every accountant knows who Luca. Is there any accountants in the room? No, you would have raised your hand if you heard of Luca Pacioli. So our Luca suite allows regulators to create financial reporting taxonomies and amend them, to create financial reporting models for a specific industry or set of industries, and prescribe them for use to report to them pursuant to the way they want to receive it, which is all based on global accounting standards. And also reporting entities themselves to automate financial disclosure. You expose your trial balances and your related data sets, and within a few clicks, you have created a accurate, compliant, properly structured financial disclosure and operational disclosure instance document, which is about 5 megabits in size, contains about 200 or 300 files, depending upon how big it is. These are anchored on-chain, in our case, on the Polygon network. The other component is the Pacioli component, which is used for external audit, external validation. So if you're an investor, you can determine whether or not the financial statements are reliable. If you are a regulator, you can do the same thing to determine whether or not you've complied with all of the specifications in a financial reporting model, within a taxonomy, within a reporting scheme. Is any of this making sense so far? Is anybody confused? Raise your hand. Don't be embarrassed, because this is akin to rocket science, this stuff. So everybody understands. So you all want to run a Pacioli node? Because you can. You don't have to be an accountant. And that's one of the interesting features of the Auditchain protocol. So anybody can spin up a Pacioli node, right? Pacioli is a logic and reasoning engine. It's built using Prolog, and on top of it is JavaScript and XBRL, Extensible Business Reporting Language, which is a global standard language across 60 jurisdictions, about 100 regulatory agencies, designed for the communication of business and financial reporting. And it was invented by our product manager. So through the use of a decentralized array of Pacioli nodes, you can validate the financial and operational state of an economic entity without the need for a centralized assurance provider. Let's read that again. Without the need for a centralized assurance provider. So that's the way a blockchain works. How many of you familiar with blockchain? How many of you understand actually how it works? Come on, Protocol Labs, raise your hand. So a blockchain involves an algorithm that engages either in a race or a consensus mechanism to confirm a transaction, a series of transactions, and a block containing those transactions, right? I won't go into proof of work or proof of stake. That's superfluous for the purpose of this conversation. But what we're doing for audit and financial reporting is converting an economic entity into a blockchain, its auditors into its validators, and its 4 financial statements into its block explorer. Does that make sense to everybody? Raise your hand if it makes sense. Okay, not bad. I actually went through the user groups. Keep in mind that it automates the work of auditors. The preparation of financial statements automates the work of accountants who are not auditing the financial statements, because if you create them, you can't audit them. That's the rule, right? Otherwise, your independence gets jeopardized. You have the cane? Are we up for time? No? You're going to pull me off stage soon? All right. There's another aspect to this which gets even more complicated. Each piece of logic in a financial statement is a separate link that contains the logic. In the world of extensible business reporting language, these are XML files, right? XML is part of the semantic web, right? It's over 20 years old. And if you are able to create, say, a rule. Now, a rule is, the overarching rule in accounting is the accounting equation, right? And that rule is equity equals total assets minus total liabilities. All financial statements are based upon that rule, right? And there are thousands of other rules that play a role. Each one of these files points to another file that plays a role in the rendering and presentation of financial statements and financial disclosure documents. So if you're an accountant or an auditor and you all have these Excel spreadsheets that have these formulas, which you think are proprietary, they're really not. That's not the point. The thing is, you perform a lot of manual labor and you get paid by the hour to do your work. So now with our platform, you can take those rules, submit it into the Luca suite in a formulaic equation. If you can use Excel and create a formula, then you can use Luca to create a rule. It gets sent out for audit or external validation by the Pacioli node operators. And when it's been proven to work correctly, it gets committed to the public library and anyone can use it. And when they do, you get paid a royalty. So now you move from hourly fees and manual labor to earning royalties and creating rules. And one day, if you retire, you can sell those rules to someone else. And those rules will gain a value based upon what kind of income they generate. Maybe it's 10 times revenue, maybe it's 5 times revenue, whatever the market will bear at the time. And that's another way for accountants to retire, because the way they retire now is they go to work for Big Four accounting firms. They work for 30 years every day, day in and day out, and they tick the same boxes every single day. And after 30 years, they might have a capital account as a partner, if it hasn't gotten dried up or if the firm hasn't gone out of business, right? In this way, you control your own destiny as an accountant. Now, if you're a consultant from the FRC who left the FRC, so you never worked for the FRC, right? You have an understanding of reporting logic, so you can do the same thing, right? If you're a company and you hire consultants to create these rules, so now the company owns the rules, so instead of the money going to money heaven or in their pockets, it stays in your pockets, and that supercharges a balance sheet because you've created an asset, which is a library of rules that generate revenue now, and at the end of a 3-year period, you can sell them and take a gain on the sale, right? That does wonders for balance sheets, but that's real money earned. So the infrastructure, the public infrastructure involves our token, the audit token. If you want to operate a node, you can stake tokens and operate the node and earn more audit tokens. Or if you don't want to operate a node, you can delegate it to someone who will operate a node and earn an income that way. Blocks is a partner of ours. Y'all know Blocks. I think they're sponsoring this event. So they're an infrastructure provider that's going to provide you with an infrastructure so that all you have to do is click 2 or 3 times and you're in business. But to operate a node, you have to understand Docker, server provisioning environments, and you have to be technically inclined. Accountants don't tend to be technically inclined, so infrastructure providers like Blocks help the ecosystem by accelerating adoption through easy-to-use user experience. If you can sign up for an email address or a hosting account, then you can run a Pacioli node through Blocks, right? This is not an uncommon thing. If you want to run an Ethereum node, you can go to any one of the larger Ethereum infrastructure providers, whose names I won't mention now, but there are about 6 or 7 large providers of Ethereum infrastructure. 5 minutes? 10 minutes. You're asking for trouble. So Blocks is a partner of ours, right, to make it real easy for accountants to spin up nodes and do their work, right? Just to clarify, the whole goal here is, instead of one set of eyes performing an audit on financial statements, you have an army, a plurality of a set of eyes, racing to fulfill validation requests, all of which come to consensus and give you a substantially higher degree of confidence, integrity, and reliability on the financial information that, whether you know it or not, you are relying upon. If you have any money at all in a saving scheme or investment scheme or a pension scheme or a mutual fund or what have you, someone is supposed to be relying on financial statement data. And when we set out to move the profession forward, and when I say the profession, I mean the accounting, audit, and financial reporting profession, we realized that we're dealing with a very, very slow-moving industry populated by the most conservative people on the planet, right? They're all based, they're all baked into a system that kind of forces them to be that way. So some of the more forward-thinking accountants we thought would be interested in doing this, and we've got an overwhelming positive response. So we were the ones that first came up with the creation of the process control NFT. NFT is a non-fungible token, right? So if you create a rule, you own the rule. And every time it's used, you get paid the royalty. The auditors that proved that it worked correctly on the network, they get paid a royalty, and our company gets paid the smallest slice of a royalty, right? And that's what we do. So what we are aiming for now is we're selling our infrastructure to regulators. We think the United Kingdom is in a position, both from an attitude perspective, because y'all have suffered more accounting scandals in the last 6 years than any other jurisdiction, right? You know which one broke the straw that broke the camel's back? Patisserie Valerie. Yeah. So when the MPs couldn't get their pastries in the morning, they flipped. They flipped out. They don't care about Carillion. They care about Valerie Patisserie. You guys know Valerie Patisserie, right? Right. Yeah. 100-year-old bakery. Gone. Audit opinions given likely moments before they failed, right? Banks in the United States, same thing. KPMG audited Signature Bank, Silicon Valley Bank, and Silvergate Bank. And they gave them a clean bill of health days before they failed. Is that right? Is that supposed to happen? I'm going to set aside the flawed nature of the accounting rules themselves, but as a depositor, I want to know right now, if we dissolved the bank, am I going to get my money? How do you do that? Total assets minus total liabilities, which includes my deposits, equals equity, right? I want to know what those securities are valued at today, right now. But that's not how the accounting rules work. See, a bank records the cost of those securities at cost. If they're 50% lower, there's no obligation to mark them to market. So an average of a 13% capital reserve, which is required from a regulatory perspective, right this second, is likely somewhere around -5, which renders a very, very good portion of the banking industry insolvent. So from an analysis perspective, if you're an investment analyst, you're a CFA, you can also create rules. For instance, net tangible book value per share, fully diluted as converted, is a rule. That's a thing. That's a lot of work for a banker at an M&A shop to perform when he's got two targets, wants to put them together. What's the net tangible book value per share, fully diluted as converted? That's a lot of work. So that rule will look at both financial statements. It knows where to look because that's standardized. The section where those securities that are convertible are supposed to live are in a specific section. And everything is standardized. So if you're an M&A banker and you want to automate that process and you create that rule, you get paid every time somebody else uses it. And you can build a thesis that automates investment research and analysis using this platform. I think he's got his cane ready. He's looking at me like the devil. Yeah, does anybody have any questions? Just raise your hand anyway. Make it look good. Hi.
So you mentioned that from a usage perspective, that the UK might be a great market for you guys to target.
Mm-hmm.
Have you had any traction or success in the US or North American market to date? How's
right now are ignoring the American market because right now they're too busy handing crypto to the legacy gatekeeper banks. Let me repeat that. You have a Supreme Court case here. It guarantees ownership of crypto in the United States to the banks. You have a regulatory agency owned and operated by banks through a revolving door policy who are using public money, my money, I still have a blue passport, my money to fund their takeover of the, really what is the game of the millennium for them. So we're not targeting the United States. We're beginning to target the UK. We're making big headroads into Dubai and the UAE. They're very forward-thinking. Their regulatory agencies are run by non-Emiratis, right? And they're forward-thinking. They're really excited, and they love what we do. And they have no oversight and supervisory infrastructure right now.
Any more questions? I've got one if not. So, in my naivety, you say if you own the rule, you get paid.
Correct.
Who pays you? Where does the money come from?
Okay,
is it licensed?
Good. That's a great question. So, if I'm a reporting entity, what I'm going to do is I'm going to perform my initial implementation, right? So let's say I'm a bank. And let's say I need 350 rules just for financial reporting alone. So I'm going to pick them out of the library and I'm going to assemble my control set. A third of them might be owned by you, another third by her, and another third by a variety of the people in the audience, right? So our platform has a billing system so that when they pay, it gets trifurcated. It gets split up between all of you. But the enterprise pays, and then there's a subsidy on the network for the first, I'm not sure of the time, but there is a subsidy of about 45 million audit tokens, which could last up to 2.5 years, so that a validation has two forms of payments that you earn to validate. One is a subsidy, the other is from the reporting entity, right? Or if you're a rule creator, right, you submit the rule for validation because it's got to be proven to work correctly. Otherwise, it can't be admitted to the library, right? So I think, did I answer your question?
Yeah, I think you did.
Yeah.
Yes, you did very well.
Yeah.
Thank you very much.
So
And
may I have a very quick one?
a very quick one. There we go. Here we go.
So I have a DeFi lending platform, and for clean energy. So the rules, I kind of create the rules for clean energy, how to calculate the energy coming in and the money, transfer it to the money.
When you say I have, you're personalizing ownership of a decentralized finance protocol. I want to let you know what you're actually saying.
Yeah. I have a team of people who are creating a DeFi lending platform using blockchain. Does it make
Okay.
sense?
Yes. Is it a smart contract platform on Ethereum? Which blockchain is it?
Ethereum.
Okay.
Yeah.
Yeah.
So we, because this is very simple platform, we're very simple, everyone can do it. Just the smart contract, we put in the rules, and that rules is going to be like if it is nothing else, then I can make money on that rules, right?
So, yeah, but I want to make the distinction. The rules that govern a single contract for lending or borrowing are baked into the solidity code in the contract.
Yeah.
That's a different kind of rule than the rules that we create,
Okay.
right?
Yeah.
The kind of rules that we create
Yeah.
are rules that constrain reporting, accounting, audit, and analysis logic,
Okay. No.
right?
You answer my question.
So what we communicate is what happens after deployment of the DeFi protocol and after transactions have occurred. In your case, on a decentralized finance protocol, in real time, right? Or as changes in state occur, the changes in state, the financial and operational state of the protocol will be communicated and rendered so that you can read them, because nobody knows. All they know is total value locked right now,
Exactly.
right? They don't know what the fractional reserve ratio is, because if I put value in, I get a receipt out in the form of an NFT or another token, right? That doesn't really trade, but I can go to Uniswap and make a three-legged market on that, right? Or I can take that and hypothecate it. So nobody knows what the base true fractional reserve ratio in DeFi really is, which is a very important number to know.
Okay, thank you very much. We've just run over a little bit on that, but I'd like to thank Jason very much for an interesting subject.